This is the Daily Market Rundown live from the Tradelo Trading floor. It's October the 18th and some highlights from today's show. ECB confirms a faster rate cut cycle, Trump odds are rising, and the Russel index is soaring. Good day traders, let's start with some overnight news. We had China coming out and reporting their GDP for Q3. Whilst it came in slightly higher than what was expected, it's still very much below that 5% that the Chinese government has set for itself as a target. Now, it's not the first time it's come in below that 5%. We obviously had a print below that 5% or well below that 5% in Q2. So it's a secondary print below that, and it does really call into question whether or not they are going to achieve 5% growth for this year. But it also explains why the Chinese government has stepped up with their stimulus program over the last couple of weeks. Now, what comes next? Well, what we do know is that the thing that's very much dragging the Chinese economy down is ultimately the property market. And that's why they're targeting it. They're creating all sorts of incentives to really get demand there picking up pace, because they do believe that is primary to achieving ultimately their target of 5% in the long run. Now, let's head over and talk a little bit about some other news. We come straight across to the ECB, and very much the ECB was in the headlight yesterday. They came out and they cut by 25 basis points. Now, that in its own is not necessarily new news, but there were a few takeaways I think that are important to stress, and we'll get onto some interesting charts in a couple of moments. But the key takeaway there was that there was no pushback on the pricing for additional cuts in December and beyond. In other words, there was no real sort of drive from Christine Lagarde to sort of say, you know what, those rate cuts are too aggressive. But the ECB opted to maintain the commitment towards keeping policy at a sufficiently restrictive level until further notice. And that in essence means that they don't want to rush back to the neutral rate, which is somewhere between 1.5% to 2%. They do want to maintain this data-dependent approach, and whether or not they truly believe that is what is necessary, well, we're going to find out about that in the upcoming meetings. Right now, economists are suggesting that next year's inflation will come in below the 2% target. Moreover, the ECB acknowledged yesterday that the inflation target is likely to be reached a lot sooner in the first half of next year rather than the back end of next year as previously expected. So it very much was a dovish ECB. It's a ECB that's telling us, you know, they're going to slightly undershoot their 2% target next year, and that is despite them continuing the path of rate cuts. Now, market expectations are for around 160 odd basis points of further cuts over the course of the rest of this year and next year. Keep in mind, there's only one more meeting this year. But what that implies is that ultimately the ECB is going to perhaps be very close to the neutral rate only at the end of next year. Now, keep in mind, if growth is sluggish, if growth does continue to print towards some form of a recession, not only are they going to have to get back to that neutral rate a lot quicker than the end of next year, but perhaps they even go below that neutral rate to really sort of soften any kind of potential impact from a recession. Okay, now let's have a look and turn our attention to some of the market moves. Well, VIX is at 18.5. Don't forget, we were sort of sitting 20 and a bit earlier on this week. So VIX has come in a little bit, and that really does give the green light for this equity rally to continue. And we'll talk a little bit about this equity rally in a moment, because there's one or two interesting things about it. We do have gold back at record highs, and interestingly, we do have the oil market sitting pretty much flat after that Chinese news. Now, that in its own is interesting, because why? Well, typically speaking, weak sort of Chinese data would normally send oil lower, and I suspect the reason oil's a bit reluctant is because how much work it's done already this week. So it's very much a case of oil feels like it's priced in everything that it can price in right now, and it will need a little bit more conviction around the Middle East situation. Of importance, of course, is do we get a complete de-escalation around the Middle East, including some form of a Gaza truce, some form of a Gaza ceasefire. If we get anything like that, it very much does put oil in play next week for further downside. Now, let's get across to some of the other interesting charts. I think one of the first one, and this is a key thing to pay attention to, is this German curve. Now, I put out a tweet about this, but this is the first time we've really started to see quite a little bit of bull steepening. Okay, in other words, what's happening in the purple here, that's 2-year yields, in the orange is 10-year yields. And what you can see for the first time, excluding of course what we had in late September, but what you can see for the first time in a while is some sort of a trending like move in this steepening in the German curve. Now, what makes this interesting is it comes directly on the day of the ECB. Now, when you get any kind of a bull steepener effect post a policy meeting, what it's telling you is that the market is giving you the verdict of that meeting. And the verdict is, Mr. ECB, you are going to have to ultimately cut rates a lot quicker than what you're telling us. Okay, in other words, the German curve is shaping itself around this idea that not only is the ECB going to have to cut a lot quicker, but perhaps they're going to have to cut 50 basis points in the next meeting. Okay, in other words, what the curve is telling the ECB is if you don't cut quicker, what you're ultimately going to do is you're going to have to cut a lot quicker at a later date. Okay, so and this is what the curve is pointing to. Keep an eye on this. I expect the steepener will continue. If it does continue, the pace of it continuing is going to weigh very heavily on the euro dollar. And that's the next chart to bring your attention to. Now keep in mind, euro dollar is a sell on rallies. Okay, this is a bearish market. This is a market now you don't want to be fading. Why? Well, because there's some key fundamental driver, and that's very much an ECB that, like I said, they need to get their skates on, and I think they are going to open the door to a 50 basis point cut at the December meeting with just a little bit more bad data. Okay, so keep a very close eye on the ECB officials, particularly when we do have some of the key European data coming out towards the latter half of this month. Now, what that means, we're looking at this euro, it's oversold. Okay, now typically speaking, one of the biggest dangers with any currency markets are typically quite forward pricing, so they do pricing things well in advance. In other words, this idea of a 50 basis point cut is going to need to gain a lot more traction to get that euro moving a lot more lower. Okay, that's what I want to point your attention to. This market's a little bit oversold. It's perhaps now going to stage a little bounce back up towards that 109. Does that mean I'm buying it towards 109? Hell no. Okay, this is not a market you want to be long of. So just because I think a bounce is coming or consolidation is coming doesn't mean I'm going to be fading it. But it does mean I'm not going to be selling it that aggressively. I'm going to wait for that bounce. Now, a bounce doesn't necessarily mean price bounces, but it does mean time allows the oversold conditions to perhaps play a bit of catch up. So I'm looking for any kind of time spent in a bit of a range here early next week, perhaps towards the end of next week, looking for some shorts for at least a retest of this rising support. But at some point, as that 50 basis point cut starts to become a little bit more consensus, I do expect we'll break lower towards that 106 mark. Okay, that's the euro. And then just a little bit of a catch up on Bitcoin. It's an inside day. It's an inside day right into resistance, key overhead resistance. We've spoken about this chart. It's a fascinating one. Okay, I think this is a market that's looking like it wants to explode, whether that means it explodes to the upside or, collapses back to the downside. It's a market that everyone is switched on for. That means you got to be switched on for it. Okay, don't be surprised to see some shenanigans over the weekend. Don't be surprised to see some, crazy moves to the upside. Low liquidity conditions. People tend to do some crazy things. But we are sitting, very interestingly, for the last 3 days, just at a significant area in the market. Okay, now again, like anything, Bitcoin has staged quite an aggressive bid over the last couple of sessions, driven predominantly, of course, by what's happening in the US elections. So right now, to really get Bitcoin going and moving, you're probably going to need more conviction that Trump is coming into the House and ultimately he is going to win the election pretty much quite easily. Okay, if that is the case, we will see Bitcoin move back towards that record highs. But right now, it's an inside day. It's a market that's moving around. It's up 1.5, then it's flat and negative, and then it finishes 1.5. So it's a volatile market. The point is, pay attention because everyone else is doing so. Okay. And then our final chart of the day, I said Russel is very much roaring, and it is. Okay, if we look at the indexes and we rebase them against one another, two very interesting things to point out. Go back to September when the Fed cut 50. What you'll notice is that the underperforming market this year in the blue is the Russel. We can see that the underperforming market really played catch up and went from a key underperformer all the way to very much being almost the key outperformer. Okay, it stayed staged almost an 8% shift in sort of relative performance over a period of sort of 7-8 sessions. Okay, so a very significant rally. Why? Well, because if the Fed's going to cut a lot quicker, that is going to support the real economy, and that's why the Russell, of course, outperformed. Now, if we go and we fast forward to the middle of this month, we've again seen the staging event take place. So we can see, of course, that since the middle of this month, what happened? Well, we started to see Trump perform a lot better than expected, and it does look as though he's going to be a lot more supportive for the real economy. We do know that his fiscal policy is going to be far more aggressive than Kamala, and he's very much looking to cut taxes for corporates. So very much Russell is one of the indices we're going to be trading over the elections. Why? Because we can see it's being influenced ultimately by who's going to win this election. So keep in mind, what we do see in the Russell now is a combination of more aggressive rate cuts from the Fed as well as a Trump victory. So if any of those two sort of proxies start to shift, don't be surprised to see that Russell start to underperform. But right now, it's very much, if you're going to buy indices, buy the Russell because it is the key performer. All right, let's then obviously go and wrap up. In terms of the eco data today, it's very, very light. There's nothing really in the way of eco data. We do have it OPEX, so pretty much all the futures, the equity futures, are seeing a little bit of volatility in the option space. So keep a close eye on that, particularly in the US session. And then finally, it is another weekend, which means there is the potential for an Israel attack. We haven't yet had the retaliation attack, so just keep an eye on that. We did see, of course, oil rally into the close for that event, but should they attack, does it mean anything? Well, it might mean something at a sort of a geopolitical level, but at a market level, absolutely not. Okay, the market is very much priced now that this will be a de-escalatory attack. So should we get that attack and oil pops up and perhaps does some sort of a bid up in the Sunday open, don't be afraid to sell that because we should not only fill that gap, but perhaps that does then give the market the all clear to then continue lower within that sort of lower range, somewhere down towards $66 a barrel. Okay, that's it for today. If there are any other questions, do post them in the chat. Otherwise, good luck out there. Always manage your risk. Go make some money.